Stay informed on earnings trends and analysis in Zach's Earnings Outlook.
Well, we're bumping up against another earnings season. The second quarter earnings reporting season going to start here momentarily. Our research director, Shiraz Mian, has stopped by to preview that for us. And when I say momentarily, we're sitting here talking on the 7th of July. And after the close of business on the 8th is when those reports are going to start trickling out.
Alcoa will report results, yeah.
Yep. So what drivers are there this earnings season? And what clear trends are you either looking for to continue or to emerge?
So the most important driver will be, is there any improvement on the top lines or not? You would recall that in Q1, what stood out was this revenue weakness across the board in all sectors. And in terms of estimates, we are seeing that same trend carry over into Q2 as well. It's kind of seeping into the rest of the year too. But with respect to Q2, revenue weakness is a persistent theme, and the driver for that are the same factors that we saw last quarter. The dollar strength was a big one that pretty much everybody was complaining about. Dollar did not grow or maintain the same momentum in Q2, the strength in dollar, as what we saw in Q1. Many folks are even hoping that it has topped out already. But still, the year-over-year comparison for dollar will be problematic for many companies. And then you have these growth questions. So yes, the U.S. economic growth picture has improved in Q2 relative to Q1, but these global issues still remain. There are these other macro factors. There is the developments in the commodities. There's questions about China and these interest rate movements. All of those are, to a large extent, have been there in Q1 and will remain in place in Q2 as well.
What about Greece? Is that going to impact the multinationals at all?
To the extent that it has a bearing on the common currency and then the common currency's relationship in parity to the dollar. So net, it could be a bit problematic, could add to the momentum that we saw in Q1. And that's the sole impact. Otherwise, Greece by itself as a market isn't much of an earnings driver.
All right. So as we open the book on another season here, are there any reports that that you have flagged with particular interest?
You know, the Alcoa obviously reports tomorrow, as you mentioned. Alcoa does get credit for being the first, though they have the tickers of AA, so that goes to their credit. But beyond Alcoa, next week is really important. We have all the major banks reporting, and the financial sector, as you know, is one of the largest in the index, in the S&P 500, and there have been some improvement in the underlying business for the financial sector. A lot of these banks have been relying on cost cuts to drive their bottom line. But there's improvement on the loan side. The capital market business is by and large doing better, particularly on their advisory side. The interest rate backdrop that they faced in Q2 was better than what they have faced in recent quarters. So financials will be key. We would like to be seeing and hearing from management team some positive commentary about trends in loan portfolios, about the housing market. We have a number of technology companies reporting next week as well. We have Intel, Google, eBay. Intel, we have had some profit warnings from some of their peers. So it'll be interesting to get some fresh color on the PC market. There are some transporters on the railroad and the airline side too. So, but pretty much a pretty big cross section of the corporate sector will be reporting next week.
While there may be some interest there, some reports of interest that come out in those sectors, are you looking for those sectors necessarily to be standouts?
The standouts, for better or for worse, technology is modestly in the negative. Finance is modestly in the positive. As I mentioned about finance, we would be very interested in hearing about what they have to say about the business outlook. Technology, we pretty much know. The total earnings for the sector are expected to be down about 2%. Take Apple out, and the negative is even bigger. Down the line, beyond next week, we have energy. I'll be very interested in. I think the sentiment has been extremely weak on the sector. Total earnings for that sector are expected to be down more than 60%. I think they'll do better. Transports, we have some of the transporters reporting next week. I think sentiment on that sector for non-earnings related reasons has been very sour. I think transportation has the potential of surprising to the upside as well.
Okay, so when the dust is all settled on Q2 and we close the books, you want to go out on the limb at this point and tell us what you're looking for numbers-wise, or is it too soon?
No, it's not actually too soon. Judging by history, typically the final growth rate for the quarter usually ends up at a place where the actual quarter had started. And to explain, what I mean by that is that on April 1st, what was expected usually ends up being the final growth rate for the quarter. So between April 1st and June 30th, the growth rate dropped from close to a decline of 4% to a decline of 6.8% right now. My sense is that by the time we close the books on Q2, we'll be modestly in the negative, perhaps 2-3% negative growth rate in the aggregate for the S&P 500. If you strip out energy, we'll be modestly in the positive, somewhere like 2-3% positive growth. Right now, total earnings for the S&P are expected to be down 6.8% on 6.2% lower revenues. I think it's going to be better than that. It's going to be 3-4% decline on 1-2% revenue decline.
Well, I'm a little confused then, because having said all of that, I'm already beginning to see reports on the wire, published reports for people looking for an acceleration to 8% earnings growth for the second half of the year.
I would like to smoke what those people are smoking. But on a serious note, they are looking for a sequential acceleration from the first half of the year to the second one. And when you look at earnings in the aggregate, there is a seasonality component to it. The second half of the year is seasonally stronger than the first half. So it's not really fair to look at the earnings growth on a sequential basis. On a sequential basis, yes, there is an acceleration, but there is such an acceleration every year.
I see.
The fair comparison is the second half of the year for 2015 versus the second half of 2014. And when you do that, it doesn't look pretty.
All right, well, don't forget, you can keep up to date on all of Shiraz's thoughts on the earnings season for the second quarter as events unfold by just consulting Zacks.com and off the homepage linking to his current earnings trends written report. And on a day-to-day basis, if you're more of a day-to-day type person, you can always go to the stock section of our website, and in his Ahead of Wall Street column is where he'll be writing day-to-day about any other nuances that he thinks he needs to comment on. If you watch our videos on YouTube when we talk with Shiraz about earnings outlook or any other videos that we produce here, don't forget you can always subscribe and comment, so you might want to do that too. In the meantime, with Shiraz, I'm Terry Ruffalo.